The US labour market, is it slowing down, and will that speed up the Fed? Welcome to Market Insight, I'm David Pollard. Today's numbers show US jobless claims for last week coming in higher than expected, adding to data over recent days in which job openings were down 23% from a year earlier and ADP payroll slipped around 19% on the prior month. All this, of course, ahead of the key reading to come on Friday, the May employment report. Well, joining me now to give her take on what all that means is Lauren Seidel-Baker, economist at ITR Economics. Welcome, Lauren. Many thanks for joining us today. Let's start with the basics of what we've seen this week in the data. Where is the strength and where are the cracks in the jobs market?
Well, the jobs market is really the case right now that bad news is good news. So as we see cooling in the labor market, I want to remind viewers that we're coming from such an incredibly tight position. This has been such a tight market, really an employees market for so long, that a little bit of directional deterioration doesn't show that the bottom is falling out from under our labor market. So it remains an employees market despite this reduction in job openings. We still have about 1.2 job openings for every job seeker out there. So the market is balancing, but it is not fully balanced yet.
So what, if any, are the implications for Friday's non-farms reading, and should, and indeed are, investors revising their outlook for the labour market more widely?
The picture that we've been seeing in these jobs reports has been one, again, of a directional path of loosening. I would be surprised if we don't see that trend on Friday continue, at least to some degree. At this point, though, it would take a major surprise, either to the upside or the downside, to severely sway the path, especially as we talk about the Federal Reserve and interest rate policy. 1 month does not make a trend in the data, so we'll be watching this number very closely. I do expect to see, again, a bit more loosening in the market. But again, the market remains tight. We see this from the trouble that employers are having with hiring, especially in certain sectors like construction and manufacturing.
Well, let's move on to the inflation picture, which I think also you see as fairly punchy at the moment. How does what we've seen with super strong services data and indeed with other components in CPI like rents and shelter, how does that square with what we're seeing in inflation?
The service sector is really what has been keeping inflation as high as it is. So the goods side of the inflation picture has been moving a little bit more linearly in that downward disinflationary trajectory. It's services and, as you mentioned, shelter costs that are keeping things high. Now, that shelter cost is supported by a very strong consumer, which is in turn supported by that very tight labor market with rising wages. So we do still see some affordability constraints in our housing market. The picture here in the United States, though, is just that we have really been underbuilding new home inventory essentially since the Great Recession. So there's a bit of a housing stock shortage, very low vacancies. That is going to keep a floor under this housing market and a floor under affordability there.
So do you see the consumer holding up then in the face of still high mortgage rates and other factors like the creeping uncertainty over the political outlook, both at home and abroad, for example?
Yes, the consumer, we see a lot of uncertainty. Consumer sentiment has absolutely taken a hit, but their actual behaviors have not taken such a steep dive. So while sentiment is turning down, I think that's very reflective of the political season that we're entering into here in the US, as well as the inflationary picture. Their wages actually are still outpacing inflation. So on a real basis, a purchasing power basis, our consumer is still holding in there. They have this dry powder to go out and spend. They're making different choices, though. Maybe that's trading down in quality. We're not buying the brand name. We're buying the store brand at this point. But it's a choice. It's not being forced. We're not over levered to this point. We still have very healthy delinquency rates, very healthy debt metrics here in the US. So while we're pulling back from our pandemic stimulus era peak, we are not seeing the ground collapse under the US consumer. There's going to be a bit of stability here for the US GDP numbers.
So what does it mean for central banks? Today we had an ECB rate cut. It's the first of the big central banks to do that. Was that perhaps a little bit premature? And what will it mean for the Fed? Will it give the Fed an extra nudge, do you think?
I think most market observers had been expecting the ECB to cut rates before the Federal Reserve, so this doesn't come as a shock to me. In my opinion, both the ECB and the Federal Reserve, it had been a matter of when we see rate cuts, not if we see rate cuts. The Fed wants to see a bit more cooling in inflation, especially that wage inflation component, that service side that we've been talking about. So I think September rate cuts are still very much on the table. We could see two, potentially maybe even 75 basis points of rate cuts this year. But I think 2 rate cuts, 50 basis points by year end is a very reasonable outcome at this juncture.
So should dollar holders sell on that basis, or is the dollar still a strong safe haven?
Well, I'm not here to give investment advice, but there are a lot of fundamental factors propping up dollar stability, a lot of re-onshoring foreign direct investment coming into the United States. That's a long-term trend that won't be changed by this relative central bank action.
Okay, we'll leave it there. Lauren Seidel-Baker, economist at ITR Economics. Many thanks for sharing your thoughts with us today. That is Market Insight. Don't forget you can watch more videos on Reuters.com.